Welcome to the Harwood Report for August 7th, 2017. It's going to be a new format going forward. Generally, I'll release these videos on Sundays. We had some technical difficulties yesterday, but we're going to have it going forward on Sunday afternoons, talking a little bit about the macros and some ETFs that I see interesting trade opportunities in. I am your host, Keith Harwood. Thank you for joining me. Let's get right into it. First things first, disclosures. All services and content are provided for educational and information purposes only and are not intended as legal or financial advice. As always, these comments are specifically just educational and informational and cannot be considered trade advice. Consult your financial advisor before making any final decisions. It is your money, your responsibility. Do your own due diligence. And let's get right into some of the commentary now. So I'm going to focus this week on the normal equity indices, spiders, Nasdaq, Russell, Dow Jones, and then after getting some of the bigger macro picture covered, I'll go into what I'm seeing in the dollar yen, gold, and then a few particular sector indices that I think have some interesting setups and some trades to watch. IYT, the transports, SMH, the semiconductor, ETF, XBI, Biotechs, and XLF financials. So let's get right into it. SPY, it's a very stable ETF right now. It tends to get very stable here around earnings, and this earnings season has been no disappointment in that front. We've seen very, very tight closes every day for a couple of weeks now. We're just sitting here on this very flat 10-day moving average. We're not even pulling back to the 20. There's not a lot of interesting opportunity here. You could try to buy near the lows of the range or sell near the highs of the range. My preference here is to sit out SPY until you break out of this tight range. If you get a move above the previous high here, which was 248, you can consider going long. You'd likely do that with calls with implied volatility very low. And similarly, if you get here below that low of basically 245.68, so just under 246, start maybe looking for that move down towards the 50-day moving average. It's not a huge amount of movement, but it's a heck of a lot more than we've seen recently. So right now, SPY is just basically showing you signs of sector rotation and not much else. There is very limited movement, very limited opportunity. But because we're getting sector rotation, there are sectors that do have something interesting. Let's move over to the Nasdaq. The Qs, they've had a little bit more of a range. Obviously, we had a very large range there. And there, we've had some good tech earnings, such as Apple and Netflix, and we've had some marginal tech earnings, such as Google and Amazon. Recently, some smaller caps have been a little bit worse. Close it so that's not in the way. The big thing for me here is the same sort of idea. If you want to play Nasdaq on the bear side and look for a pullback towards the 100-day moving average, I think you certainly want to do that via puts. And in all likelihood, for us to see that sort of 4 or 5% drawdown, it's going to take us a month. So you want something with a little bit of time to expiration. I don't see a major problem with trading for that, but I don't see a necessary reason that we have to do that. So for now, I don't necessarily see a big trade here in this ETF either. There have been some buyers of puts for protection. There has been a little bit less leadership here, but there's nothing to say that we need to come all the way back down here to the 200-day moving average until we start seeing a break. And until we start seeing that break, I don't necessarily want to play, especially since my trades are focused on options. Time decay matters. You can't really just go into it and hope that that this is the week that we break. IWM, the iShares Russell 2000. This has had an interesting pullback. It's gotten down to the 100-day moving average, bounced a little bit on Friday with an inside day. This could be more interesting, except for the fact that I haven't seen an obvious support level here at a key moving average. We've gotten below the 100-day moving average and then bounced back above. It seems like we're basically in random walk in the small caps. If you want to play for something here, I'd probably say you're looking to play for the bounce using the 100-day moving average as your stop. And then you look back for a move, into the 143, 144 range. It's an okay play. Again, I would do it via options. Look, maybe at some 142s that expire in 2 weeks, but it's not a great R&R just because that type of move is relatively priced into the options, even though volatility is low. So because we've had low volatility and you expect a smaller balance, you just don't get a huge return out of options. Finally, the Dow Jones, this has been our real winner the last couple of weeks. It's just been trucking higher. Have had really good earnings out of a few of your key names here in the Dow 30, so that's really what's been driving this. The sector's small, or this index is very small. It's only got 30 names in it. It's not that important, other than the fact that it's been talked about a lot on CNBC. But this is not your main driver of market returns. I think you want to be more focused on S&Ps and Nasdaq than anything here. But this is something to be aware of, that maybe there is some money flow, and this is where some of that money flow has been going. So if there's any rotation where people stop putting money into the Dow Jones, maybe that could be finally what gets the S&P out of its tight range. But basically, over the last week, the money flow has been saying buy Dow Jones and sell small cap. So you're buying those 30 industrial names and selling the small cap names. If people look to take some money on that, maybe you start to see a little rotation the other way. It's kind of a chop game in these indices. Let's get into the first real trade opportunity we're starting to see here, and USDJPY. So this is the dollar-yen pair trade. The dollar-yen trade. So the key here for me is seeing a very interesting potential move. Note back on June 15th, we crossed the 10-day moving average, and it used that as support the whole way up. July 12th, we closed below it. It used it as resistance the whole way down. We closed right below it Friday, and we are trading right on it right now. A close above the 10-day moving average could signal a new trend in the dollar-yen pair. Why this matters is gold. When the dollar is strong relative to the yen, it tends to be weak for gold. And when the dollar is weak relative to the yen, it tends to be strong for gold. Gold already crossed below its 10-day moving average. It's testing against the 50 and the 100 right here. The 20 is actually just below those. If the dollar-yen closes above the 10-day moving average, I would expect this to resume a real downtrend, get back down towards the 115, maybe even a little bit lower level down here towards 114. And then you're just waiting to see that dollar-yen to close back below the 10-day moving average to create the next uptrend. So right now, this is on high alerts for me. One of two things is going to be happening in USDJPY, and that will determine my trade. If we get a close above the 10-day moving average, then I'm going to look for some puts in gold and GLD. If we get a close below, then I'm probably going to wait it out until I see a little bit more room away from the 10-day and continuation of that trend. Maybe if we get back down towards 110, then that tells me that the uptrend in gold should recommence, and you look back to calls in either gold via GLD, gold miners, GDX, or silver SLV. Today I'm going to just focus on the put side because that's the one that's closer to coming to fruition here. So we look over at GLD. Take a look at our charts here. This is loading. Okay, so volatility-wise, you can see the implied volatility is near the lowest level it gets on a 30-day basis. Realized volatility has been dead. You can see up here. Implied vol generally around 10%. Historical vol recently has been closer to 7%, but longer term is 9 to 10%. So that's the key here, is if we start to get a break, maybe we start to see this implied or realized volatility resume back towards 10%. Where I'm really looking to key in my trade is this September 1st expiration. That includes the next non-farm payroll number. Not that I'm going to necessarily hold through that non-farm payroll number, but I think you get an implied volatility bid because that was the trigger for the bigger move on Friday. So this implied volatility at a very small premium to the August 25th implied volatility is a little bit of a mispricing to me. If I'm going to be bearish, I'm looking at something for a move down towards, like I said, 115 or 114. we go off of a 10% implied volatility over the course of 1, 2, 3, 4 weeks. That's going to tell you that we're looking for a move of about 2.5 to 3% as a 1 standard deviation move. So that would put us back down towards 116. So for me, I'm going to look at about closer to the 117 strike, maybe the 117 and a halves. There is a chance that we get down as low as 115 or 114 just off of a full 1 month long trend like we've seen in the past. But I'm going to go a little bit tighter just to improve the probability of my payoff here. Plus, I can get a little bit lower implied volatility buying under 10% instead of closer to 10.5, almost 11 up here. So what I'll look at today, tomorrow, is if the dollar yen closes above the 10-day moving average, I'm looking at maybe these September 1st 1.5 puts, and then managing that trade. If we do break, as I would expect, I will look towards selling either a lower strike put to turn into a put spread, maybe these 115s once they get up into the 20s, or I can go over to August 25th and sell something maybe like these 116s if they get into the 20s. That way I can reduce my premium a little bit, but hold the better volatility here, which is that September 1st premium. To give you a little bit of perspective, so you see that this is trading at a 25 basis point premium to August 25th. We check it in SPY. The September 1st is trading at about 3/4 of a vol, 0.8% higher than August 25th. So this is a much bigger premium here into September 1st weeklies because of that non-farm payroll number. Excuse me. So this looks like a little bit of a mispricing to me that GLD September 1st vol is a little too low. Same idea, you know, in the Nasdaq we've got a 0.5%. And so now let's move over though. So that was GLD for you. So I'm looking at, again, I'm looking at some puts there. But I need to see that that close in the dollar yen pair above this level, which is about 110.80. Let's go over to the individual ETFs I mentioned. First off, transportation. This has been something that a lot of people have been talking about as a sign that the market is turning bearish. It has underperformed the Dow Jones industrial average and was looking very weak as of about Wednesday. And then on Wednesday, it got to the 200-day moving average and bounced. Now it's trading at the 10-day moving average. If it gets above, should see a little bit more rally here. Probably look towards the 172, 173 range without a lot of difficulty. Excuse me, and that would help negate that thesis for many people that, oh, this is a sign that the market is about to turn bearish. So, how do I want to trade this? Look back at our volatility levels. You can see some of it up here, 13.5% implied vol for the 30-day, and really Friday we had a really big dip in implied volatility, so it's looking cheap here. Part of this comes with bounce. They bid up the implied volatility expecting the market to collapse. It didn't happen. Now that the implied volatility is coming back off, the insurance premium is coming down. Now you can look at maybe some out-of-the-money calls. 13.5%. If you're looking for a 2-week type trade, you're looking for, again, maybe a 2.5%, 3% move. That will put us around 171, 172. For me, that would mean that I'm looking at something maybe around buying these August 170s at 47 cents if I can get them mid-market. And similar to GLD, what I would do is looking into a rally, I'd look to try to sell some of these 172s against it. I just don't know that we're going to get up to 174, 175, where these would really hurt me. If I turn this into a call spread, right now it's around 30 cents fair value. If I could get it for 30 cents, I would just maybe buy that. If not, then I'm going to look to buy these for around 50. Get into a rally, sell these for 30 or 35 if my rally occurs. If we start to break, I'd have to stop out of these, you know, between 25 and 30. I don't want to risk too much on those. And if we do start to break in the transports, there's no point in keeping these August 170s with only 2 weeks to expiration. If we start to break, it's a sign that the 170s probably won't play out. And I'd have to look towards maybe some bearish sectors to see if I can find a bearish trade. Maybe somebody else is actually right that the transports are giving you a leading indicator that the market is getting ready to break. So this one's pretty simple, just with volatility where it is. August 170s are kind of where I'll be keying in to start this week. Next up, I mentioned SMH. This has been a big leading sector for the Nasdaq. It's the semiconductors. We've heard a lot about semiconductors and how powerful they are for Bitcoin mining and everything else. gaming, etc. Just, this is a sector that has had a lot of commentary about it, and it's been a lot of hot money. It's done really well. When it peaked, people got a little bit scared in Nasdaq. It pulled back to the 100-day moving average. Then it bounced. Now it's pulled back to the 50-day moving average. This is kind of in a spot where it's got a little bit of interest to me. You could see a pullback to the 100-day moving average again. You could just bounce off the 50. I'm not so sure where it's going to go in the short term. What I think is important here is longer term, what we're seeing in the options market. There's some decent open interest on the downside here in August, the 80s and 77s. That's a pretty big break for the next week and a half, but excuse me, 2 weeks. But that doesn't mean it's out of question. The bigger timeline for me that matters is November. So big buyer of November 76 puts, 35,000 of them. If we start to break, that could help really drive some momentum, especially if it starts to occur a little bit in the next couple of months as opposed to today. Those pick up a lot of gamma if we get into October, trading in the high 70s or low 80s. This is just something that's in the back of my mind as a flag of something that I need to be aware of. It's not something that I necessarily need to trade about today, but if we start to see the semiconductor sector break down into the low 80s, I know that these really start to matter a lot more. So just something to be aware of, particularly if you're trading any of those individual names like Micron and NVIDIA. You just have to be aware that there has been a big buyer of these November 76 puts. It was a few weeks ago. You can see here, excuse me, that the big buyer was near the end of June here, but he bought a lot. All right, let's go on then to something a little more tradable today, and that is Biotechs. Another sector that people were a little concerned with because you had a very sideways chop. Nice breakout. People got a little bit excited. Then it consolidated a little bit. Looked like it was breaking out again and then started to fail. Pulled back to the 50-day moving average and it immediately reversed. Basically touched the 50-day moving average. It was a perfect reversal off of that 50-day moving average. A lot of people like buying a pullback to the 50-day moving average on a name or on stocks and indices that have broken out. So this kind of went textbook style turnaround there. Now with this buying we saw on Friday, it increases the odds to me that we're going to see a move into the low 80s, maybe up to 81 or 82, retest these highs in the next couple of weeks. The other thing that we saw on Friday that was really important in XBI, it's a big order. 20,000 of the 79.83 call spreads traded for 79 cents. That's about 1.6 million in premium, just under. That's not a small bet for the biotech ETF. Expect it was somebody rolling down these August 83s. What I'm thinking here is that this guy's thinking the same thing. Move back towards 81, 82. He had these 83s. Those were dead money, but they still had some premium to them. Might as well roll them down, get them into the 79s, and a move to 81 or 82 turns these into a decent R&R. They could double or triple his money for him. For me, if I'm looking for that move, first off, I'm expecting 1.5% move per day, or over the course of the 2 weeks, about 4.5%, 5%, call it. That'll be just under $4. That would get us to just about 82. So if we're going to get up towards 82, I like the strike, maybe the 80 or 80 and a half, probably like the 80s, 80 and a halves, right in this range would be a pretty good trade for me. And I think that with the biotechs, we may see an increase in implied volatility into a little bit of a rally here. So, we had that nice spike higher and that increased the implied volatility. But the implied volatility has been pretty stable. It's moved from right here in the 22s up to maybe 28.5%. That's a pretty good move. But a lot of the trade has been right around 25, 26%. It's not particularly cheap today. It's near the lower end of the range. Could certainly get up to 25, 26, but not likely to go much below 22. And we saw that this realized vol picked up during that rally as well. So for me, what I'm looking at then again is looking at maybe these August 80 and a half calls or the 80s. And into a rally, I would probably, if the volatility gets increased, I'd look towards selling either the 82s or 83s. We know that there's a lack of interest on the 83s and above. If somebody comes in buying a bunch of out-of-the-money calls into a rally, that's great. These could spike up in towards 25 or 30 cents. That's a great thing to sell against, buying these in the low 50s. Again, if we get a sell-off, you got to cut your losses on these. Do not hold them until there's worth nothing. If we lose half the premium, you probably want to be out because then they're just unlikely to pay off. You just don't want to try to fight it either doing a roll down or anything. The guy that did the roll down here has a lot more money and a lot more conviction. And when we're trading small and trying to kind of follow the tape as opposed to being the ones that dictate the direction of the move, it makes it a little harder to justify. So for me, again, August 18.5 calls is kind of my focus here for this week in XBI, and I need to get them cheap, but if I can get them in the low 50s, then I think that they've got an interesting payoff potential. Final trade, XLF. Financials were on, we'll say on fire at the end of last week. I mean, we're talking about pretty small moves here, but basically XLF finally broke through $25, made a new 52-week high on Friday, settled close to 25.5. A number of the names have been doing very well. Morgan Stanley, Citigroup have looked exceptional. Goldman looked pretty weak, and then during this part of the rally, it helped put a little bit of a tailwind to the financials, and it looked fine as well, reclaimed its 200-day moving average. Generally speaking, financials look a little bit strong here and have been getting talked up as a sign that the economy is doing fine, and financials will do fine, and everybody thinks that the rotation will continue into financials. Well, I'm not so sure that the rotation is going to continue into financials, and part of this is driven for me, again, off of the option flow. We had two big trades on Friday that I want to highlight here. December, the 23-27 risk reversal. So we came in selling 20,000 of the calls, buying 20,000 of the puts. This is likely hedging a long stock position. So it's not necessarily that this person expects us to stop rallying. They just don't see a high probability that we rally versus sell off from here. This trade actually pays off perfectly if you get another $1.50 rally over the course of the next 3-4 months. But in the short term, maybe it's just reducing their delta a little bit. The bigger trade, though, that matters more for today and what's going on now was the August 25th 24.5 puts. So these expire in 3 weeks, just under. This got about 20,000 of the August 25th 24.5 puts for 8 cents. First off, 8 cents is expensive. It doesn't sound expensive. I know it's dollar cheap. It's only $160,000 a premium, but you're buying maybe about 18% volatility here, a little less than that. Buying about 16% volatility, 16 to 17% volatility when your historical vol has been around 10. You look at the charts, 12, it peaks at around 16. Right now it's been around 12, and realized vol has been in the gutter just like everything else. So this is somebody that's got a little bit of concern here, a little bit of fear. I'm not sure this is somebody hedging a long position. I would think that this may actually be somebody taking a, sort of that lottery ticket type bet of, well, if financials do get a turnaround and drop down towards 24 bucks, they've got a pretty good payout. We look back at that underlying chart and you can see 24 is a ways down and it's below the 50-day moving average, but it's not out of the question. I like this chart a little bit better for terms of looking at it. If the stock starts to fade, if the ETF starts to fade and gets below the previous 52-week high, which is right around 25.30, then I might look here and think about some of these puts with an expectation that we drop back here into this 24.70 range. Right here we've had a lot of trade happening for a few days here in the 24.75, 24.7, down towards 24.60. You can play for that move and actually still make money in the options if you choose your strike well. So we know that this guy bought 20,000 of these. If you could get the August 25th puts for around 15 cents, that's not too bad because into a break you expect to see this volatility spike up. Alternatively, look into the August 18th 25 puts. Maybe try to get those for around 11 or 12 cents here on a break of about a dime. You should be able to get those for that price with the 25 delta. I don't think there's any reason you'd want to pay more than about 12 cents on these, but if you get a little bit of a break and it looks like the financials are going to get some money rotating back out, I would certainly look towards the August 18th 25 puts or the August 25th 25 puts. And then just for a point of reference here, I'm not necessarily looking at September 1st in the financials, even though the non-farm payroll number does matter a lot for financials. You can see that that's got a full 1% vol premium. Remember, in GLD, it was only 0.25%. So if I'm going to look at something as a non-farm payroll play, I'm going to do that off the precious metals, not off the financials. So that's what we've got here for today. Again, looking at potential call plays in transports and biotechs, and put side plays in gold and financials. Contact me, tradeacademy.co, email keith@tradeacademy.co. My phone number is there, 312-600-8004, Twitter handle @tradeacademyco. I hope you guys enjoyed this week's Harwood Report, and we'll continue doing this on a weekly basis. Have a great day trading.